Hello, everybody. This is Rolanda Watson, and I am a tax strategist and enroll agent. So, what I want to do is I'll tell you a little bit about myself in case you don't know me. I've been in the industry for over 25 years, helping individual and small businesses file their taxes, current and back taxes. I also help them find tax savings. Yes, I dig through your return and dig through your life to find legal tax savings for you. And then I help fix your tax problems. I talk to the IRS on your behalf, negotiate for you, and get you the best negotiation that I can with the Internal Revenue Service. But today, I want to talk to you a little bit about what our current administration calls the beautiful big. So I will be looking at my notes on this side, but I'll also be paying attention to you while I'm updating you and giving you information. The emphasis of this video will be on the individual taxpayer. So that will be our W-2 workers, our senior citizens. Um, I will have another video that will talk about businesses and that will cover our sole props, our LLCs, partnerships, S corps. Those are the pass through, and then also a little bit about the C corp on there. But for this particular one, let's just talk about our individual taxpayers and our seniors. First of all, I want you to remember that in this big, beautiful bill, as our administration calls it, we are extending tax cuts and tax exemptions and allowances from the previous bill by Donald Trump. That bill was from 2018 to 2025. So actually this year, we have a lot of tax laws that were expiring that we were actually waiting to see what will happen. And this is the answer to where we are with these bills. So the first thing is I want to let you know we will still have the income brackets of the minimum of 10% all the way to 37% as a individual. Now that's going to be separate from our C Corp because the C Corp is taxed at flat 21%. But for the individual taxpayer, our minimum tax bracket is 10%, and we go all the way up to 37% in increments. That looks like 10, 12, 15. Let me get those exactly. 10, 12, 22, 24, 32, 35, and 37%. That is going to be based on your income once we get through with that. But that's where we are, and that still stays the same. We have those brackets there. We do not have personal exemption. If you remember before 2017, we used to have an exemption per taxpayer that was cut out 2018 through 2025. That is still the same now. We do not have personal exemptions this year. As every year, our standard deduction does go up a little bit, $1,000 to about $2,000. So this upcoming year, it will be $16,000 for a single individual and $32,000 for a married filing jointly. Our seniors will get a boost this with this particular bill of 65,000. That's 65, age 65 and over, they'll get a boost, and that will be from 2025 to 2028. That's not a permanent tax law. It is temporary from 2025 to 2028. Child tax credit will go up to $2,200. Now remember, you may be saying, well, it was more than that before. Remember, we're looking at what happens when the first bill expires in 2025. It reverts back to 2017. 2017, our child tax credit was $2,000. So now we got a bump of an extra $200. So $2,200 per child. Now it still is children 16 and under. Now, refundable credits will be there. And again, with all of our credits and deductions, there is a phase out amount. What I mean by that is there is a certain amount that if your income goes over a certain level, it's different depending on whatever credit or deduction it is, that credit or deduction will start to decrease. So you just want to talk to someone and make sure that we're within those lines. If you are one of my clients, we'll discuss that and make sure that you at least know where your phase out is if you have questions about that. Now we have some above the line deductions that are really they're kind of cool. We did experience a little of them in COVID. And what I mean by above the line deductions is these are deductions that you get before you get to your tax amount. So we have our income, and then we have different deductions that we will get, and we get our standard deduction, and then we have an above the line deduction. A couple of those that we've heard of a lot is tax on tips, no tax on tips. So I want to go into that a little bit to make sure that we really understand what that means and you understand what that means in your individual tax situation. No tax on tips. The top of that, or it goes up to $25,000. That also means that you customarily receive tips as a part of your income. So we're talking about a job where you customarily receive tips. A driver, your gig workers, customarily receive tips. DoorDash, hairdressers, estheticians, who else? Those who work maybe in Vegas, you work in the gambling industry, those industries that it is customary that you receive tips. Those tips then also are recorded by your W-2. Typically, you're filing a form 4137, which you're reporting those tips, and your employer is reporting those tips. Now, for businesses, that operates a little different, and we'll have to talk about that. But for those who customarily receive tips, those tips go up to $25,000 where there is no tax, and they have to be in a customary industry where you receive tips, and it has to be noted, of course, on your official form, your W-2 form. Now, the overtime pay is still kind of the same thing. It goes up to $12,500. So if you're receiving overtime generally on your job, I know in some industries you may work, you're always working overtime. For instance, I'm here in Texas, and if we have a hurricane, then we have our electric companies. They may just be, I mean, they're on it until they can't work because they have so many things that they need to do. Well, you're capped at $12,500 for no tax on that overtime. So just so that you understand that. But what I mean by above the line is, let's just say you made $100,000 and you really did receive tips of $25,000. So instead of you being taxed on the 100,000, you're then going to be taxed on the 75,000. That's pretty much how that works when we talk about above the line. We also have car loan interest. You'll be able to deduct up to $10,000 of your car loan interest, and that again will be above the line. That's a car that's purchased from 2025 up to, I think, 2028. You can use this 2028 or 2029. But the interesting thing about this, and the thing that you want to be careful of, is the car, its final manufacturing of the car must be in the United States. So in our administration, there's been a lot of back and forth about making sure that we have parts and manufacturing that is here in the United States. So in this particular rule, you want to make sure that when you get this car, that its final components, and ask the questions when you're getting this car. Its final components for manufacturing this car has been in the United States, because that's what you're going to need and show proof of in order to get this up to $10,000 for credit for that. Another above the line deduction that we'll have this year, we had it during COVID, but they've made it a set part of the tax return is that's your charitable donations. So if you've given up to $1,000 as an individual or $2,000 as married filing jointly, you'll be able to write that off without having to itemize your tax return. And typically when you itemize, you're using the interest from your home, property taxes from your home, and contributions to nonprofit organizations. Well, instead of those contributions to nonprofit organizations being in your itemized, now you can bring them outside of your itemizing and just be able to use them anyway. So that's a good thing. So above the line deductions that are big differences in our tax return upcoming this year: no tax on tips up to $25,000, no tax on overtime up to $12,500, car loan interest up to $10,000. Make sure that that car is finalized and it's manufactured in the United States. And then charitable contributions for an individual, $1,000; for married filing jointly, up to $2,000. So that is going to be some things there for the individual. Another thing is earned income tax credit. Of course, we're used to, if you qualify for earned income tax credit, you're used to receiving that. It's going to be up to, for 3 kids, up to $8,046 this year. And the limit raised for married filing jointly is right about $68,000. In the future years, I'm not sure if it's going to be 2025 because they still have to work out some specifics with it, but typically when you need to make proof of carrying your kids, Social Security card, school records, documents that prove that you have the right to carry the child, those things are things that you would have in the event of an audit, and you would probably provide with your professional. Well, they're making steps now to make sure that you provide that information at the time of filing instead of in a spot audit. So that's something that's not, it's supposed to come through in 2026, but I'm telling you now so that you can prepare yourself for it, however you need to do that. The SALT deductions, that's the state and local tax deductions, last year or during the 2018 to 2025 tax bill, that was capped at $10,000, and that was a big issue with people. So temporarily, they raised that to $40,000. So in our states where property tax is pretty high, this will be a great asset to them. So remember your state and your local tax. If you are itemizing, you can take that up to $40,000. Again, that's temporary, but at least they have it back now. At this time, it is stated by 2030, it will go back to 10,000, but at least now they'll be able to use that at 40,000. Now, there have been some extensions on audit when it comes to ERC and some of the other credit claims. So instead of the typical 3-year before the IRS can come after you for certain audits, they've expanded that to 6 years. So there's just an FYI with that. That's not really with compliance, but it is letting you know where their mindset is with audits and enforcements, because they will be, they will be looking at their enforcements. The 1099-K, just to remind you, 1099-K is how the Internal Revenue Service reports your income that you receive from a third person, a third merchant, Square, Stripe, those type of things. That amount has gone back to the $20,000 or 200 transactions. So be aware of that for those who work in an industry where you're taking the third-party merchants. Just beware. And if you are not getting these transactions for your business, but however you've told the third party it's for business, you want to make sure that you let them know that it is not for business. This bill was over 900 pages, and in the tax part of it, you're looking at about 300 or 400 pages. So of course, I didn't go into all the details. I've given you a highlight and an overview so you can really take an assessment of your personal world and see how any of this will affect you. Again, if you are a business owner, you file a Schedule C, you've elected yourself as an S Corp, you have a partnership, or you a C Corp, then there are some more provisions that you have that will be for you, and they will be in another video. Until the next time, remember that I make taxes stress-free, helping you minimize your taxes in legal ways. Until the next time, have a great day.